we've laid out what I think is very clear guidance on liftoff. And it's really three things: labor market conditions that are consistent with our estimates of maximum employment. And as I mentioned, we consider a wide range of indicators in assessing labor market conditions, not just the unemployment rate. Inflation that has reached 2% and not just on a transitory basis, and inflation that's on track to run moderately above 2% for some time. The first two of those three are very much data-based. The third does have a little bit of an element of expectations in it. So we are very much determined to implement this guidance in a robust way. It is the guidance that we chose carefully to implement our new framework. And to meet these standards, we'll need to see data, as I mentioned. So what does this SEP really say? It says that we're committed to our framework and to the guidance we've provided to implement that framework. We will wait until the requirements set forth in that guidance are clearly met before considering a change in our policy rate. And the last thing I'll say is this. The state of the economy in 2 or 3 years is highly uncertain, and I wouldn't want to focus too much on the exact timing of a potential rate increase that far into the future. We'd like to see inflation run moderately above 2% for some time. And we've resisted, basically, generally, the temptation to try to quantify that. Part of that just is talking about inflation is one thing. Actually having inflation run above 2% is the real thing. So over the years we've talked about 2% inflation as a goal, but we haven't achieved it. So I would say we'd like to, perform. That's what we'd really like to do, is to get inflation moderately above 2%. I don't want to be too specific about what that means because I think it's hard to do that, and we haven't done it yet. When we're actually above 2%, we can do that. I would say this. The fundamental change in our framework is that we're not going to act preemptively based on forecasts for the most part. And we're going to wait to see actual data. And I think it will take people time to adjust to that and to adjust to that new practice. And the only way we can really build the credibility of that is by doing it. We monitor a broad range of financial conditions, and we're always attentive to market developments, of course. We're still a long way from our goals, and it's important that financial conditions do remain accommodative to support the achievement of those goals. And if you look at various indexes of financial conditions, what you'll see is that they generally do show financial conditions overall to be highly accommodative, and that is appropriate. So that's how we look at it. I would add, as I've said, I would be concerned by disorderly conditions in markets or by a persistent tightening of financial conditions that threaten the achievement of our goals. We think the stance of monetary policy remains appropriate. Our guidance on the federal funds rate and on asset purchases is providing strong support for the economy, and we're committed to maintaining that patiently accommodative stance until the job is well and truly done. There was a time when there was a tight connection between unemployment and inflation. That time is long gone. We had extremely low unemployment not extremely low. We had low unemployment in 2018 and 19 and the beginning of 20 without having troubling inflation at all. We were at 3.5%. We were bouncing around with unemployment 3.5% to 4%. And it wasn't just unemployment. Participation was high. Wages were moving up. It was a very healthy thing. And we didn't see price inflation move up. There is a relationship between wage inflation and unemployment. But that has not, what happens is that when wages move up because unemployment is low, companies have been absorbing that increase into their margins rather than raising prices. And that seems to be a feature of late cycle behavior. So we're not, when we seek to achieve low unemployment, high levels of employment, which is our mandate, we think we have the freedom to do that based on the data without worrying too much about inflation. As the economy reopens, people will start spending more, and that you can only go out to dinner once per night, but a lot of people can go out to dinner, and so. And they're not doing that now. They're not going to restaurants, not going to theaters. That part of the economy, and travel and hotels, that part of the economy is really not functioning at full capacity. But as that happens, people can start to spend. it's also wouldn't be surprising if, and you're seeing this now, particularly in the goods economy, there'll be bottlenecks. They won't be able to service all of the demand maybe for a period. So those things could lead to, and we've modeled that. Other people have too. And what we see is relatively modest increases in inflation. So, but those are not permanent things. What'll happen is the supply side. The supply side in the United States is very dynamic. People start businesses. They reopen restaurants. The airlines will be flying again. All of those things will happen, and so it'll turn out to be a one-time sort of bulge in prices, but it won't change inflation going forward because inflation expectations are strongly anchored around 2%. I would expect, it's very possible, let's put it that way, that you will see bottlenecks emerge and then clear over time, and you'll probably see that over a period of time because, really the strong data are ahead of us. Right now that the checks are going out just now, and that'll add to spending. COVID cases are coming down. Vaccination is moving now quickly. The really strong economic data is coming. It should be coming, assuming we stay on this track. And that's when you'll really know where the bottlenecks are. But you can see, though, that these are not permanent. It's not like the supply side will be unable to adapt to these things. The market will clear. It just may take some time. And some of the answer to that may be price. In many cases, it won't be price.